All right, so as promised, we are going to very heavily discuss the concept of cost in this chapter as we get into kind of the introductory portion of managerial accounting. And we already discussed the fact that cost can be either direct or indirect. And we said that direct costs are easily traceable to a cost object, but that indirect costs were not so easily traced to a cost object, and so we have to allocate them in a manner that is reasonable. If we want to expand upon the concept of cost, we need to recognize that there are direct and indirect costs. That's just kind of the tip of the iceberg, so to speak. So we have here on this screen four different types of costs, and three of these are very relevant to the discussion of managerial accounting as it pertains to manufacturing costs. And then we've got a fourth one that we're going to discuss as well. Let's look at variable cost. It says a variable cost is one that increases in total as output either increases or decreases in total as output decreases. So when we think about this, and we say that we want to make, say for example, um, a swimming pool. Every swimming pool that we make is going to cost us a little bit more money. Let's say that we want to make a fidget spinner. Okay, all of the materials, the direct labor that goes into that, every unit that we make is going to increase the cost that much more. And if we cease production, we have no variable cost. Okay. So we have a factory, and if our production is zero, our variable cost is zero. Let's say that each unit costs us $5. We make one unit, our variable cost is $5. If we make 10 units, our variable cost is $50. So these go up in a linear manner as production increases. Each additional unit of production results in an increase in cost of a set amount, so much per unit. A fixed cost is kind of the opposite. It says that a fixed cost is a cost that does not increase in total as output increases and does not increase in total as output decreases. So I'll give you a real good example of this that you can relate to. Now, this is not a good example for business or manufacturing, but think about a lot of you will have a car payment. Let's say that your car payment is $500 a month. Your car payment is $500 a month, whether you drive the car or whether you don't drive the car, right? But if we think about gas for that vehicle, that would be a variable cost. It's going to go up. The more miles you drive, the higher that cost is going to be. We also have what we call mixed or semi-variable costs, and these contain, says, a portion that is both fixed and variable. And they give us the example of utilities. So, I am from originally a very warm weather climate, but in the wintertime it would get at least a little bit cold. And what would happen is that I had a store down there, and in the summer months didn't really have any use for gas as an energy source. In a retail setting, I use mostly electricity most of the year, and the only gas we would probably use in the summertime would be if somebody went to the restroom and washed their hands and used hot water. I mean, that would literally be it. But we would still get a bill every month for gas that was, say, $25, even though I knew to a certainty that I may have used 25 cents worth of gas in that month. But then in the wintertime, another story, right? got to turn that heater on and get the bill. And let's say that the bill was $100. Well, $25 of that $100 was that same $25 I was incurring in the uh, summer. That was the fixed cost component. Didn't really have any use in the summertime, but there was a fixed cost component of simply allowing me to have gas, leaving it on if I wanted to use it. Okay. Then in the wintertime, the bill goes to $100. That's because I was using more variable costs. So in the summertime, get a bill for, let's just say it was $25.20. Almost all of that is going to be fixed. Then in the wintertime, the utility bill is $100. Maybe $75 of that is variable cost with the same $25 fixed cost. And then we have this unique type of cost here, opportunity cost. And I want to circle back around to what we talked about at the beginning of the chapter as far as uh, decision making and alternative one versus alternative two. It says an opportunity cost is the benefit given up or sacrificed when one alternative is chosen over another. And a really good example of that, particularly for college students who are full-time college students, residential college students. Um, you may say you're a younger person, 19, 20 years old, and basically your job is to go to college. You're taking, say, 15 hours a semester, something like that. You may have a little part-time job on the side, but let's say that your job is what you make is insignificant. $3,000 or $4,000 a year, and you could have just gone straight out of high school, maybe even without having any kind of skill, and gotten a job that paid 25 or 30,000. But you went to college instead in the hopes that when you graduated, you'd be able to make 50 or 60,000 and plus all of your raises that you would get on top of that for an extended period of time. So, you're saying, okay, well, I'll take an extra 20 or 25,000 a year for, say 40 years, and I'm willing to accept the fact that for the first 4 years out of high school, I might make 80, $100,000 less, even if I have a part-time job, by going to college. So opportunity cost. You go to college. I'm not talking about the cost of going to college as far as tuition or anything like that, but the benefit given up, the benefit being a full-time job, right? So you're giving that up because you chose the alternative of going to college full-time. And then, of course, we're hoping that down the road that decision pays off. So when we talk about product cost, um, now that we've looked at variable, fixed, and semi-variable costs, we need to understand that this is no longer financial accounting. We're not going to be given product costs. We're not going to be given purchases or the per unit cost. We're going to be calculating that. So it says here, products are goods produced by converting raw materials through the use of labor and indirect, in other words, difficult to trace, manufacturing resources such as the manufacturing plant, land, and machinery. So basically what this slide is telling us is that any cost that is incurred simply because we are making a product is going to be a product cost. Okay. So any cost that goes directly into this television or hamburgers, even if it's an indirect cost, if that cost is being incurred because we are producing a product, it is going to be a product cost. So again, we've got some examples here that are very, very different. A television is very different from a hamburger. Automobile is very different from a hamburger. Clothes and furniture, not the same things, but these are all examples of products. So any cost that we incur that must be incurred to make that specific item is going to be a product cost. So when we talk about, the CEO of the company, that is not a product cost because that individual could be the CEO of a different company. Support staff, these are generally not going to be product cost, at least if they're in billing. Your sales force, these are not product cost. Only things that go into making that product are going to be considered product cost. Do want to talk just for a moment about service costs. You've already seen this, and this will have more relevance when we get into. It says slide 1 of 2. I think we only have this one slide here for service costs, but this will make a little bit more sense when we get into our next chapter on job order costing. But I do want you to understand that there is a decision-making process involved in service-related businesses, such as providing medical care. Let's see, what else do we have? Insurance, rental services such as car rentals. And it does say that these services differ from products in many ways. Of course, the service is intangible. Once you have performed the service, it's over. And notice it says services require direct contact between the providers and the buyers, and that is absolutely a true statement. So, not going to spend a whole lot of time on service costs, mostly because we're going to be able to kind of cover that in the next chapter when we get into job order costing. So determining product cost, how do we do that? Well, very, very important. It says here, product costs are inventoried. So anything that goes into the cost of a product, whether it is some type of a material, whether it is some type of labor, or whether it is a cost that we are allocating, that we are incurring because we are making a product. For example, we have a factory building, we pay taxes on that factory building. That is a product cost. We may also have, let's just say hypothetically, a separate building where we have all of our administrative services, and we're going to pay property taxes on that building as well. That is not a property cost. Okay? So it says product costs are initially added to an inventory account. That's what they mean right here by product costs are inventoried. And they're going to remain in inventory until the item is sold, at which time they are transferred to cost of goods. Should have another word there, cost of goods sold. All right. And in the past, as I've already said, you were given the product cost and you had a way to determine cost of goods sold. A little bit more complicated in a manufacturing environment. It says here product costs are classified as direct materials, direct labor, and manufacturing overhead. So these are the three components of product cost. Okay, direct materials generally pretty easy to determine. Direct labor pretty easy to determine. Overhead costs, yeah, that's when we're going to have to put on our thinking caps a little bit more. It says here that direct materials are materials that are part of the final product and, here's that word, here's that phrase again, can be directly traced to the goods being produced. Okay, so a windshield for a car, for example, is a direct material. Very, very easy to trace. This is how much the windshield cost. It is for this type of vehicle. Direct labor is the labor that can be directly traced to the goods being produced. So if we're on an assembly line and we are stitching a pair of jeans with a machine, we are installing that windshield that I just talked about, this is called direct labor. But do notice here, It says that a company can also have indirect labor costs. And indirect labor is not as easy to trace. It's going to become a part of overhead, as are other things. So manufacturing overhead, it says all product costs other than direct materials and other than direct labor are going to be considered manufacturing overhead. We've got some synonyms here. Manufacturing overhead, also known as uh, factory overhead, factory burden, support, etc. So anything that is considered manufacturing overhead is a product cost other than those that can be easily traced. So it says here manufacturing costs are included as manufacturing overhead if they cannot be traced to the cost object of interest. For example, a unit of product. So I gave you an example. They've got some examples here down below. Let's just actually go with the examples that we have here in on the slide. It says manufacturing overhead includes a variety of items such as depreciation on plant buildings and equipment. In other words, we would not be incurring this depreciation expense if we didn't have the plant building or if we didn't have the plant equipment to make our product. Janitorial and maintenance labor. We would not incur these costs, right, if we weren't making the product. Now, if these individuals go over and they work in the administration building as well, see, we have to split up their salary or their wage. Plant supervision. So the guy that's actually on the assembly line is direct labor, but his boss is part of manufacturing overhead. The plant supervision, he's making sure that this guy up here is doing his job. Materials handling, moving items from one place to another. Utilities for plant utility, power for plant utilities. So, we have an electric bill so that we can see what we're doing. Well, we're going to allocate that over the amount of output or the amount of goods that we produce. And then property taxes for the plant, kind of the same thing as depreciation, although that's property taxes are a cash expense. Same thing. Our property taxes are $5,000. We're going to allocate that over all of the various products that we make within our factory setting. All right, we're going to get into some actual examples with some calculations next, but we're going to wrap this video up now.